You rely on banks and governments when you pay with cash or a credit card. But with digital currencies, you can send money directly to someone without a bank. Is traditional money the best option in today's tech world? Robert Kiyosaki, the author of Rich Dad, Poor Dad, has some intriguing insights. This video explores whether we're nearing the end of what Kiyosaki calls fake money. Now, what does Kiyosaki mean by the end of fake money? Let us first understand the devaluation of money. Money devaluation refers to a decline in the value of a country's currency to other currencies. It means that the currency can buy fewer goods and services than previously. Devaluation can be a deliberate action taken by a government to stimulate economic growth, or it can occur due to market forces due to inflation, trade deficits, or changes in investor confidence. At one point, money was backed by the tangible value of gold or other precious metals, legal tender for anything of equal value. Kiyosaki described the moment in 1971 when President Richard Nixon detached the US dollar from the gold standard as a turning point that rendered the currency fake money. You see, before 1971, the US dollar was linked to gold. This meant that every dollar you had could be exchanged for a specific amount of gold. It gave the dollar an accurate and stable value because it was backed by something tangible. Things shook up when President Nixon decided to disconnect the dollar from gold. The US dollar became fiat money, which means any physical asset like gold does not back it. Instead, its value comes from people and businesses believing it has worth because the government says it does. The US dollar, the world's primary reserve currency, has significantly decreased in value over the past 10 years. You can purchase approximately 25% less with the dollar today compared to 11 years ago. This decline in value can be attributed to the fact that the dollar is a fiat currency, meaning any physical assets or intrinsic value doesn't back it. The value of fiat money is based on trust. People believe in it because of the stability of the government and its economy. So, what causes a currency devaluation? Number 1, inflation. Inflation is the rate at which the general prices for goods and services rise. When inflation is high, the real value of money decreases, leading to diminished purchasing power. If a country's inflation rate is significantly higher than that of its trading partners, its currency will likely lose value. In Zimbabwe during the late 2000s, hyperinflation, extreme price increase, rendered the Zimbabwean dollar practically worthless, forcing people to abandon it in favor of currencies like the US dollar. Another thing that causes currency devaluation is trade deficits. A trade deficit occurs when a country imports more goods and services than it exports. This imbalance can put downward pressure on the currency. When more domestic currency is needed to purchase foreign goods, the value of the domestic currency can drop, resulting in devaluation. If the U.S. imports significantly more than it exports, there is a continual demand for foreign currencies, leading to a potential decline in the value of the U.S. dollar. In April this year, the United States, one of the top economic superpowers in the world, experienced a growing trade deficit due to a significant rise in imports that outstripped a modest increase in exports. According to the Bureau of Economic Analysis from the Commerce Department, the trade deficit expanded by 8.7%, reaching $74.6 billion. The third cause of currency devaluation is market speculation. Investor perceptions and speculations highly influence currency markets. If investors believe a country's economy will weaken, they may sell off that currency, causing its value to drop. Speculative actions can trigger a self-fulfilling prophecy where the initial devaluation leads to a further loss of confidence. In the 1992 Black Wednesday event in the UK, the British pound fell sharply due to massive speculation against the currency, leading to its devaluation. Another thing that causes a currency to lose its value is political instability. Political events such as instability, uncertainty, or conflict can lead to losing confidence in a country's currency. Investors may pull their money out, leading to decreased demand and currency devaluation. In Venezuela, ongoing political turmoil and economic mismanagement led to hyperinflation and a significant devaluation of the Venezuelan bolivar. The fifth cause of currency devaluation is monetary policy. Central banks control monetary policy, impacting inflation and currency value. If a central bank adopts policies that increase the money supply without a corresponding increase in economic output, it can lead to currency devaluation. The Federal Reserve's actions during the 2008 financial crisis, which involved lowering interest rates and implementing quantitative easing, were intended to stimulate the economy. However, these measures also led to concerns about inflation and the possibility of devaluation. Now, what are the consequences when a currency loses its value? Well, the number one consequence is that prices will increase. As the value of money decreases, the cost of goods and services increases, leading to inflation. Consumers find their currency does not stretch as far, impacting their purchasing decisions and behaviors. And how does currency devaluation affect your savings? If the prices of things keep going up faster than the interest you're earning on your savings, you might find you can buy less with your money over time. Let's say you have $10,000 saved in a bank that gives you 1% interest each year. After a year, you'd have around $10,100. However, if inflation jumps to 3%, the things you could buy for $10,000 last year now cost about $10,300. So even though your bank balance looks higher, you have less purchasing power because the money doesn't stretch as far as it used to. Moreover, countries with a lot of foreign debt, like China, the US, Italy, Japan, and France, might struggle because paying off these debts becomes costlier if they're in stronger currencies, putting extra pressure on their finances. While devaluation can sometimes boost growth by helping exports and encouraging local production, if it's not managed well, it might lead to economic problems. For at least 5,000 years, money has been a part of our lives in different forms. But as time has passed, regular money has been losing value. This has helped to create something called sound money. You see, sound money is a currency that holds its value over time, is widely accepted, easy to break down into smaller parts, durable, and scarce. Think of it like classic gold coins. They have been valued for centuries because they're limited in supply and highly trusted. This differs from fiat currencies, like the cash in your wallet that governments can print endlessly. This excessive printing can lead to inflation, where your dollar buys less and less over time. An excellent example of sound money is Bitcoin. Launched in 2009 by an anonymous entity known as Satoshi Nakamoto, Bitcoin was created in response to the 2008 financial crisis, which exposed the vulnerabilities of existing monetary systems. The decentralized peer-to-peer network allows transactions without intermediaries, offering an alternative to traditional banking. Over the past decade, Bitcoin has seen an exponential growth in adoption, both among individual users and institutional investors. Major companies and payment processors have begun to accept Bitcoin, signaling recognition of its utility and potential as a medium of exchange. One of Bitcoin's most significant attributes is its capped supply of 21 million coins. This scarcity is akin to precious metals like gold, making it an asset that can resist inflation over time. The blockchain technology underpinning Bitcoin provides a decentralized and immutable ledger, making it secure against censorship and fraud. Moreover, Bitcoin's limited supply protects against inflationary policies and hyperinflation, positioning it as a valuable hedge against conventional fiat currencies. Investors have increasingly turned to Bitcoin during economic uncertainty, driving its value and recognition as a store of value. So, should you continue holding on to cash? No. Kiyosaki anticipates that the stock market is poised for a downturn, citing that it has remained high for an extended period. He advises investors to consider adding 3 inflation-resistant assets to their portfolios to safeguard on their investments. One of them is Bitcoin. With a capitalization of $1.33 trillion, Bitcoin ranks among the most prominent entities globally, surpassed only by 6 companies. When the Federal Reserve was busy raising interest rates, Bitcoin didn't do so well compared to the broader market, but things got better for it once the dust settled. Lately, Bitcoin is experiencing a bullish trend, priced above $66,000. Despite its substantial growth, many experts believe there is still potential for further appreciation. Analysts project that Bitcoin's value could reach $652,185 by 2030. Investing in Bitcoin may be a choice, especially considering the decline in purchasing power of traditional currency. The second investment that Kiyosaki suggests is silver. Silver is popular for electric vehicles and solar panels because it conducts electricity well. Car makers use silver in essential parts like automatic braking, power steering, and navigation systems. Plus, silver is increasing in value as industries prioritizing sustainability expand, with industrial demand projected to rise by an impressive 7%. The great thing is getting into silver investing is easy. You can buy silver coins, bullion, jewelry, or ETFs that track silver prices. It's a friendly way to get started with investing. And the third investment that Kiyosaki suggests is gold. Over the years, gold has proven to be a reliable safeguard against inflation and the decline of crucial currencies, making it a worthwhile investment option. Gold offers financial protection as a universal asset in geopolitical or macroeconomic instability. Additionally, gold has tangible uses. It's utilized in fields like electronics and dentistry. Nowadays, acquiring gold is simpler than ever, and you can invest in it without physically storing or protecting the metal. As of 2024, the gold spot price index has shown an impressive average return of 21.46% year to date. If the Fed keeps raising interest rates, the US dollar will weaken. This can cause the prices of gold, silver, and Bitcoin to drop, which means these investments become cheaper for people looking to buy in. This is the best time for you to build a resilient portfolio. If you want to create a more robust investment portfolio by starting a business, sign up on Workity.com. This free platform allows you to promote your products, services, or deals at no cost, whether based in the UK, the US, or anywhere globally. Additionally, if you're searching for a job in any niche, whether you're just starting or have extensive experience, Workity is an excellent resource for your career search. Remember, personal financial education is important. When you understand personal finance, you can create a budget, make smart investments, and plan for a secure future. It helps you deal with debt, grow your savings, and work towards financial independence, which can improve your financial health. You can avoid common mistakes and build wealth with sound financial know-how. By focusing on learning about finances, you're not just managing your money. You're setting yourself up for a happier, stress-free life. Like, share, and subscribe.